right, everybody. Jimmy Vreeland from Joint Ops Properties back with Ryan Lee from Atlas Wealth Solutions. We're going to do a quick YouTube video on an interesting article I came across last week. The main thing when we've been talking about these whole life policies, the main objection we get is that it's too good to be true, and then why isn't everybody else doing this? And so when we do see examples of someone else doing this, especially a highly sophisticated, highly paid person in the media, we're going to bring it to your attention.
Okay, awesome. Yeah, Jimmy, I appreciate you bringing this article out. This is really interesting because, a lot of times I think we get financial information from people who are doing the exact opposite from what they tell us to do. It's do what I say, not what I do. And this is a perfect example of this, right? So Jim Harbaugh, interesting individual, right? He went to coach, left the 49ers, went to coach Michigan last year. And as part of his compensation package, Jim Harbaugh is getting increased compensation in the form of a life insurance loan. So what we thought we'd do is we're going to break this down, and we're going to talk about why Jim Harbaugh, number one, would want compensation in the form of a life insurance loan, and number two, why the University of Michigan would agree to such a deal there. So who is someone winning in this circumstance? Is someone losing? So we're going to talk a little bit about that and kind of break this down a little bit. But
this goes into my theory that when you get paid as a W-2 employee, you just have a tax target on your back. It's the least sophisticated way to get paid. It's the least efficient way to get paid.
You got it, right? And that's going to be point number one, is why use life insurance. And you mentioned it's the least efficient way to get paid. The reason for that, Jimmy, is the tax code. It's written in such a way to tell us what we should do if we want to keep more of our money, right? The first part of the tax code, 9 pages of the tax code is written for W-2 employees because, to your point, Jimmy, there's no way out. You go to work, you get your money, and before it ever hits your bank account, your taxes are skimmed right off the top, right? If we use
for the
tools,
political class, they're the easiest targets.
Easiest targets, you got it. So let's talk a little bit about these numbers. So Jim Harbaugh is getting, he went from $5 million in salary to $9 million in salary in 2016, but the additional $4 million is coming as a loan from the University of Michigan, of which the loan will be used to fund a life insurance policy. So Jimmy, what kind of life insurance? We haven't seen this policy, but we know from this article what type of policy it is. Most people, when they buy life insurance, they buy it for a death benefit. But if you know what you're doing, you can actually use life insurance as one of the most unique financial tools out there. What are some of the aspects that are involved likely in this life insurance policy?
He is going to take that cash, and he is going to not pay income taxes on it. He is then going to fund a policy. I think the big bridge people have to get over with this whole life insurance policy is like the death benefit. Who cares? It's not about the death benefit. It's a more efficient system and a better place to put your money than a bank. It has several other advantages, and we've done several videos attesting to that.
You got it.
But this is a more efficient way for him to collect compensation. And in the long term, for his heirs and his family, it's unbelievable.
So the premium, so for him, I think what they say, they were doing $5 million in premium plus another $2 million for 5 years. Right, so what would that be? That would be 10. That would be a total of 15 million in premium. So that 15 million in premium coming into this life insurance policy is going to get broken down in two different ways. And Jimmy, you mentioned it. Most people, when they buy life insurance, they buy it in such a way that the only thing they get is the death benefits. And insurance companies, they're good at what they do because they know when you're going to die, right? And so when Jim Harbaugh got this policy, they did extensive underwriting on him to find out, okay, how healthy is Jim and what's the likelihood he's going to pass away in a given period of time. But in addition to the death benefit, as you mentioned, it's really a cash value play, right? And a life insurance policy, when it builds cash value, you get some very unique benefits, right? You get number one, a guaranteed rate of return plus a dividend. Your money is 100% safe. There's a lot of people worried about the stock market right now, so the life insurance company will literally guarantee your growth. It's not tied to the stock market. But this
Harbaugh doesn't want to be playing the market to maximize his returns. He wants to be coaching football.
You got it. This right here is the thing right here. So tax-free. If you think of all of the places you can put your money today, most instruments, most vehicles in which you can put your money are either taxable, right? You pay taxes as you go, or you defer your taxes to a future date. Real estate is, gives you tax advantages, but there are still taxes associated with that. Life insurance is one of only 3 remaining places where you can literally put your money and have it grow tax-free. So tax-free, and then your cash value. This is the fun part, right? Your cash value is liquid, and most people will use their policy in 2 ways. They'll start off taking loans, which we're going to talk about what Jim's doing, and then at some future points, they will take distributions, which is income, but all of which is coming back tax-free, and this is all independent of the death benefit, right? Regardless of, whenever Jim passes away, the death benefit will pay out, but while he's alive, he gets to use all of these benefits.
Right. I mean, the death benefit's great, but this deal is so sweet without the death benefit. Because net, however he decides to spend his money, he's going to spend it the same way, whether taking a policy loan or if he took it as salary. The only difference is he has a lot more of it.
You got it. So they built in, it looks like, a clause on this that protects the university. So coming back to the University of Michigan, why would they give Jim Harbaugh a $15 million loan to fund a life insurance policy? That's because they know one day Jim's going to die. Whether that happens tomorrow or 35 years from now, one day he will pass away. And
every year he doesn't pass away, they collect more interest.
You got it. And that's exactly how they're doing. They probably took a loan and they amortized it over 10, 15, 20, 30 years. It doesn't matter. They just continually amortize it. And whenever he passes away, the loan plus the associated interest is due. But how does that loan get paid out to, and all of the subsequent growth, how does it get paid out to the University of Michigan?
Tax-free.
Tax-free. So this is an investment.
What do schools have, like Harvard? What is that called?
Their endowment fund? Yeah.
So this money's sitting in the endowment anyway, and they're looking for guaranteed rates of return.
Yep.
And so how magical that they can compensate an employee and then get a guaranteed rate of return off how they compensated their employee.
Yep. And regardless, it's actually a sweeter deal. The longer Jim lives, the more money they're going to get back tax-free. That $15 million is going to grow every single year, and at some future point when Jim passes away, the amortization of that loan will be paid out tax-free to the University of Michigan. So this is an investment, a guaranteed collateralized investment for Michigan.
Start the webinar with, do as I
say, not as I do.
Right, because Ann Arbor is a hotbed for pro-social policies, tax people so we can pay for our ivory tower social programs.
You got it. Now here's the
I love it. They're fine with everybody else getting taxed, but they're going to do everything they can to avoid it. That's awesome.
So now let's look at Harbaugh. Harbaugh is allowed to borrow against the policy while he is living, but he has to keep at least 150% of the premium value untouched. And so the reason he has to keep this untouched is he's got to protect the associated death benefits with that's going to pay out the University of Michigan. He's got to keep that protected for the University of Michigan. But the rest of the cash value that's in the policy, Jim Harbaugh now gets an opportunity to grow his money and use the capital at the same time. So Jimmy, tell us a little bit about what you're doing with your policy and how can you grow your capital and use it at the same time?
Go find another investment. Find a piece of real estate. Find anything that you think has a good chance of a return.
You got it.
You're also getting your return from your life insurance.
So when you take a loan from the insurance company, you've already taken a couple loans against your policy. Did they ever ask you what you're doing, why you're taking a loan?
Nope.
How you're paying it back?
Awesome.
Right?
Nope.
You're in control of it, and the reason for that, again, it comes back to the death benefit. They use your death benefit as collateral because they know if you pass away, they owe you money anyway, so they'll pay out they'll pay out the death benefit minus the outstanding loan. So Jim now gets a way to receive compensation tax advantage. He's probably getting taxed, on that $15 million, not as ordinary income, but he's getting taxed in some type of a bonus rate. So it's going to cut his tax bill in half. He's then going to take that money, put it into a life insurance policy, grow it tax-free, have the ability to utilize that capital for whatever he wants while he's alive, whether it's a loan or a distribution. It protects the University of Michigan, and whatever's left over in the death benefit will pay out to his family, his heirs, here's his estate. So it's a win-win all the
And
way
he can
around.
probably take a policy loan to pay his tax liability on this deal.
You got it. And that's probably it 100%, man. This is probably a zero out-of-pocket money for him, but it's a way to beat the tax code, have liquidity, have control, and get compensated at a higher amount with a lower tax liability. And it protects the University of Michigan.
So 150% of the premium value untouched. If he puts $10 million into this and his cash value is $20 million, he can only pull policy loans off $5 million of that. Is that what that means?
Yeah, the difference between what goes in and what's available.
Okay, so it's going to take a little time for that cash value to grow up.
Yep,
or grow.
It'll take a little time for that, yeah.
And that incentivizes him to be a great Michigan coach to keep this thing going.
No doubt. And then
and where is in the article what his family gets?
Oh, yeah.
Let's talk about that real quick.
Yeah. Let's see, where is that down here? As long as the insurance policy stays active, Harbaugh does not need to repay the loan until he dies, because again, the death benefit will cover it, so he gets to use the money without ever having to repay it. Can recoup its original investment, and the rest of the insurance payout would go to whomever Harbaugh chooses as his beneficiary. So whatever's left over, and this is why what we'll do, we'll go through a case study, and we'll show the total amount of death benefit, what goes to the University of Michigan, what pays out to his family. And the longer Jim lives, the better investment this is, both for the University of Michigan and as well as Jim and his family. Because everyone wins in this example. Everyone, with the exception of the government, who just lost millions of dollars in tax revenue.
But then how will the University of Michigan pay for all the social programs they want to inspire?
Do what I say, not what I do. Let's win football games and get the right people in, getting compensated the right way, and then everyone else can pay the taxes.
That is awesome. These people, they're great.
Okay.
All right, well, we wanted to do a quick video, just bringing people's attention to this concept, and thanks for watching.